exist in most of the mega cities around the world. Women get harassed going to work, almost 90% harassment rates across some of the mega cities around the world.
Wow.
And at the same time, it's quite scary, actually. And your only other option is taking on-demand transportation, the likes of Uber, Lyft, etc., and their equivalents across the world. But you could be a doctor in a city like Cairo, for example, and make $500 a month. So can you really spend $20 a day taking an Uber and going back every day, basically, to go to work? Most likely you cannot, right? So what we found is that there's very large fleets of very high-quality buses that work privately in these markets, that work with tour companies, corporates, schools, you name it, and they're extremely inefficient. They would work only twice a day. They would work very seasonally 6-8 months a year, and for the rest of the year, for the rest of the day, they'll be sitting around empty, not doing much. So what we wanted to do is basically build our own parallel mass transit system. Take these buses and minivans that are underutilized from the private sector and use it to create a parallel mass transit network that can deliver an affordability, so almost 80% cheaper than taking an Uber. Reliability comes on time every time. You always have a seat. And safety, where you guaranteed that you have your own seat and you're not going to get harassed, basically, if you're a woman commuting every day to work or to school. We started 5 years ago, basically from idea to IPOing today, our debut on NASDAQ. We've done close to 90 million rides over the past 5 years. We operate in 20 countries, in 100+ cities across the entire world, from LATAM to Middle East to Africa to Europe.
90 million rides, and where did most of those come from regionally, and are there any regions that have been growing in particular for you as of late?
Yes, so we started in North Africa. We started out of Egypt, and then we moved our headquarters to Dubai. So our business, a lot of it is still in the Middle East, but very rapidly growing across Europe, across LATAM. Most recently, just in the past month and a half, we've launched Argentina, we've launched Chile. Over the next few months, we're launching many more countries across both Europe and Latin America. We've completed, just over the past 4 or 5 months, almost 3 acquisitions across these geographies that are helping us accelerate our footprint quite significantly. We're expecting very, very soon to be announcing more acquisitions of that type that can accelerate our footprint, our global footprint.
And so these vehicles that you're using, Mustafa, as you mentioned, they're either unused or either buses, vans. We're looking at some of the B-roll here now. And how does the economics work out? Can you give us an example of kind of how the money flows when you have a full, let's say you've got a full one of these vans, there's 8, 10 people in it or whatever. How does that work for your profitability? And are you profitable at this point? How does that look eventually? What's the ideal economic kind of unit case here for a full van of riders?
Absolutely. So great question. The problem generally with, and why we face a huge product market fit, both on the supply and demand sides, but more importantly on the supply side, is that these vehicles were inherently very inefficient, right? A school bus would work twice a day. We'll take the kids to school in the morning, we'll bring them back in the afternoon, and for the rest of the day, we'll sit around empty, kind of not do much. If you work with a tour company, it's probably you're going to work 6 to 8 months a year, right? And that means that the cost of financing of the vehicle, you have to basically split over very few number of rides per day, per year, to be able to make money on top of the vehicle cost, basically, and the incremental cost of fuel and maintenance and salary, et cetera, et cetera. So by being able to utilize this vehicle that was previously basically very underutilized, working only twice a day, using it across intra-city transport, intercity transport, across B2B contracts with the likes of Amazon, for example, so on and so forth, you're effectively increasing the utilization of this asset, significantly increasing the utilization of that vehicle, and hence increasing the aggregate earnings of that vehicle. While you increase the aggregate earnings of that vehicle, it's actually not proportional, right? The more you're able to increase the rides per driver, per vehicle, the less you need to pay on a per seat level, because almost this comes at no opportunity cost. It's pure kind of bottom line gains for the vehicle owner. The less you need to pay on a cost per seat basis, the less you can charge the consumer, and the more the total addressable market you can get to. So we break even at around 40-50% utilization of the vehicle, which allows us basically to get to almost 30-40% kind of gross margin levels, which is very, very healthy, basically. We operate in most of the markets at a break-even kind of net margin profitability, so pre-OPEX kind of profitability. And we kind of invest our resources primarily in scaling up our technology. So we have around 400 engineers, operation research, mathematicians, data scientists who work on solving these extremely complex problem of building a mass transit network.
Mustafa, I'm looking forward to tracking along with the business now and having this conversation again in the future. We got to leave it there for now, but in particular, it seems like the use of the underutilized vehicles puts you in a particularly unique spot that's very different from our own ride-hailing here and the problems that these businesses are trying to figure out with the driver situation and how to pay and whether or not we need autonomous vehicles. Sounds like you're able to find some infrastructure that can be used to your advantage. So very exciting. Congrats and thanks for being here.
Thank you so much, Oliver.
Absolutely.
Great to be with you.
For sure. Looking forward to more. Mustafa Kandil, CEO and co-founder at Swivel. SWVL will be the ticker. GMBT is the SPAC deal that was announced today. All right, time for some overlooked stock action before we close it out. George Tillis is here with us from Salt Lake to look at a tech company that actually was okay today, George. Pretty notable little beat down here in tech companies across the board, but CDW, the IT business services provider, got an upgrade from Morgan Stanley, and it managed to end the day positive. What are they saying?
Yeah, I mean, slightly positive today, OJ. I mean, at the end of the day, we can't go up on a straight line every single day, so we're getting some pullback in the tech names. But there are some companies out there, and there is some work being done by analysts. And today, Morgan Stanley upgraded CDW. They've actually moved their price target to 214 from 201, and they've got an outperform rating versus an equal weight rating. But the company is, interesting enough, one of the global leaders in the IT infrastructure space. They help digitize businesses, if you will, help clients plan, design, install, and even support their IT systems, their end user access devices, as well as their network and cloud infrastructure. And the other thing is they implement not only the design and install, but they support these services on an ongoing basis. So basically, for businesses that want to outsource their IT infrastructure solutions needs, CDW is one of the mainstay competitors out there. Much like Accenture, we talked about Infosys and Wipro, which are the two Indian competitors in this particular space. But I think the call today from Morgan Stanley was really a valuation call, and I think that's what's been going on with the analysts, not necessarily a call on earnings or something sort of exogenous based on a deal or additional business that is coming to fruition. But I think it's relative performance, because if you look at the last year, CDW has underperformed Accenture and Wipro and Infosys, but you look forward, and it looks like from a valuation standpoint, based upon the forward multiple of 19, that's a significant discount to their main competitor, United States Accenture, at around 35. So I think this is a valuation call, and again, it's a marginal increase from 201 to 214.
Okay. We heard the bull case for Accenture earlier, and a little bit of market overlap between these two companies, George.
Yeah, there is, definitely. And so that's the thing. They're the main competitor in the United States. Accenture is certainly growing faster, at least on a trailing basis, than CDW. But I think CDW was forgotten by many of the analysts out there, not because, of course, it's being outcompeted by Accenture. It's not as robust when it comes down to sales growth or EBITDA growth, but I think valuation now is making a little bit of a comeback for the name. In other words, price relative to forward earnings, it's trading at a significant discount to Accenture, but also at about a 2-point discount, around 19 versus 21 for the industry group. So I think this is a valuation call, and perhaps also a little bit of a market share shift to CDW.
Okay. George, interesting find, stock that it is getting a little appreciation on a weekday and going up against some pretty big competition with the likes of Accenture, but maybe that is a little bit already known. Everybody knows Accenture, right? CDW potentially with a little bit of market share take. All right, nice find, GT. Mr. Tillis from Salt Lake with the overlooked stock of the day. Tomorrow's employment, going to be a busy morning. We've also got data for the economy through PMIs as well. So I'll see you in the AM, get some sleep, myself included.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome to Your First Trade. I'm Scott Connor, a 30-year veteran trader, and it is Thursday, March 31st. We're wrapping up the end of the first quarter of 2022. That's something we'll address in the last portion of today's program. Break down not only today's action, but what are the takeaways from the first quarter of this year. Now, what else are we going to cover? Well, we're going to kick things off with Ben Watson and talk about an example trade based on the stock Walmart, symbol WMT. This is not a strategy based on an earnings release. We're going to be just looking out a few weeks and put on a directional option strategy after we break down the charts with the chart master. And then we're going to join Jeffrey Avalos, and we're going to talk about a topic that's been circulating quite a bit in financial circles, and that's the yield curve. We're going to talk about what it is, how the mechanics of it work, and why is it so important to long-term investors. So that'll be an interesting takeaway. And again, the last portion, we'll break down what impacted the markets today and talk about any takeaways. Well, let's kick it off with the top. Start off with our example trade on Walmart, symbol WMT. Everyone knows this stock, one of the biggest retailers, obviously, in U.S. or perhaps the world for that matter. But before we get to the actual trade itself, let's do as we usually do. Bring in the chart master, Ben Watson, joining us from Salt Lake City. Ben, thanks again for joining us here on Your First Trade. We're looking at Walmart, a name that we have looked at in the past a few times, but it's been a little while. So, Ben, we'd love to hear your takeaways from what you're seeing technically from the charts of Walmart, Ben.
Sure. Well, I'll tell you what, Scott, you mentioned that Walmart, one of the largest retailers out there, and perhaps one of the most consistent. You walk into one Walmart, you walk into another Walmart, and they look fairly similar. And what looks fairly similar over the course of at least the last year is this kind of long sideways trend that we've been seeing in Walmart, really moving between a range somewhere around that 134 mark up to about the 152 mark or so. And despite the fact that it's had those kind of wild or strong oscillations between those two levels, it's stayed roughly sideways if you look at it from that perspective, roughly equal lows, roughly equal highs. And the stock most recently, after coming up off of kind of that double bottom bounce around that 134, 135 level, now makes this bull flag rally and is heading towards, or seems to be heading towards, that resistance up around that 150, 152 level. So it breaks out of a resistance just in the last 4 days. Above that 146 resistance, we get a gap up and a rally. pretty strong rally, as a matter of fact, over the last 4 or 5 trading days. Now, today's candle's a little bit different because we get a gap back down into the middle of the range of yesterday's strong bullish candle. But it's a bullish candle in and of itself, but it's still a little bit of a spinning top. So you get a long upper shadow, you get a long lower shadow, a fairly narrow body of today's candle within the range of yesterday's move. And that could be a little bit of an indication that perhaps this stock is slowing in this upward run. But then you've got the fact that it's tested that 152 level twice before. And it's made those strong oscillations very similar to this, maybe a little bit of a pause prior, and then it rallies up and tests that resistance. The 50-period moving average starting to turn back up a little bit here. The RSI running up towards that overbought range. So some bullishness, but perhaps tempered a little bit by maybe this little bit of a pullback ahead of that resistance up around that 152 level. Scott?
You know, Ben, I'm looking at this chart, and I'm looking at that low here that we had in February 24th, which was obviously when many stocks and indices hit the lows for this quarter. And it got all the way down to 132, Ben. And here we are staring at 150 just a short time later. So that's a tremendous move back up. My question is for you, Ben, is that when we see a move that quick and taking it right back to that level that you talked about, where it's been tested several times already, that 152 level, anything particular about today's candle? I'm sorry if you already mentioned a little bit, but I'm just seeing that, you know, here we got back close to that 152 again, and the candle today doesn't look like one that's particularly strong. I might be wrong there, Ben.
No, you're absolutely correct, Scott. And the fact that the stock moved higher originally. In fact, it gapped down from yesterday's close to open and then rallied up and then came off of those highs, but at the same time went lower than today's open and then came back up towards the end of the day. That suggests that maybe this is buyers and sellers trying to figure out an area of price equilibrium. And not that it may pause here for very long, but it certainly is a less bullish candle than what we saw yesterday. Now, that doesn't mean that tomorrow's candle won't be stronger or weaker from here, but it certainly is a little bit of a pause in this upward movement and could be an indication that maybe we don't get all the way up to that 152 resistance if this starts to move again.
Got it, Ben. All right, well, again, some good takeaways there, but a tremendous move run up here, including even some gaps I can see on the way, but even just the last 5 days, tremendous run. Of course, Walmart's not alone. Other sectors have had some good runs as well, but today market seemed a little bit different in terms of tone, Ben, so maybe we'll consider that in our example trade. All right, Ben, great breakdown of the charts of Walmart. Thanks, and look forward tomorrow to breaking down the week with you on the major indices and your takeaways from those charts. All right, Ben, see you tomorrow. Thanks again. All right, let's go back to the Thinkorswim platform and go right to the trade tab, starting with time and price, as we always do. Time, how far out do we want to go? And price, what does the trader think the stock might do? So if a trader's thinking in terms of the stock running up, as Ben had pointed out, and getting up to those levels of those resistance levels, about the 152, let's put that together with a potential trade that might make sense for a trader who thought that maybe the stock won't continue or break through that level, particularly with the move it's already made here, and the market's maybe slowing down a bit. I think there's also another piece of data, economic data, that one might want to consider, and that we saw numbers today for personal outlays. In other words, what are personal incomes and outlays, sort of how they playing out here, and that number was a bit disappointing. We saw that in January. It was like 2.1, and we got it here for February down to 0.5%, and that missed and came in even weak there. So if they're thinking maybe the consumer is not as strong as maybe one had thought, let's go out, tell you what, let's go out 2 weeks. We'll go out 14 days on this example trade, 14th of April. And the stock currently trading at 148, so I'll highlight down here where it is now, 148, 149, right in this area here, okay? Now, if someone were not to think that the stock would maybe go above that 152.5 level, that Ben was talking about, let's look at selling the 152.5, 155 call spread. So I'll start off by clicking on the bid price of the 152.5 call. Okay, so there you go, selling one of the 152.5 calls. And then buying the 155 call. Now I'll hold down my control key, click on the ask price, and that purchases the 155. Now, this says right now about a 41 cent credit. I'm going to take that just a little bit higher because, again, the bid ask was fairly wide here on the closing quotes. So just in case it does move a little bit higher, or if Walmart kind of tests the high levels that it saw today before it backed off a little bit, the value of this call spread may increase just a little bit, and that would increase, of course, the likelihood of getting filled at this particular level. So let's see, 45 cents. Okay, that's fine. I'll leave that in there, and I'm going to change this from day until good till cancel, right? Because we have a couple weeks before these options expire. So if it doesn't get filled tomorrow, perhaps Monday, of course, assuming markets are open and everything's normal, we'll have a chance to work again. So let's check out what this means in terms of max loss and max gain. All right, let's hit confirm and send. And let me scoot this up to the middle, and you can see max profit would be the 45 cents times 100. That's the multiplier. $45 minus any transaction fee, and the max loss would be $205. It's a $2.50 spread, so the maximum value of that spread would be $250. But from a seller standpoint, that's the maximum loss. If you're selling something for 45 cents, you don't want it to go to $2.50, right? Because essentially, think in terms of that would be approximately where you'd be buying it back, so to speak, in terms of figuring out the P&L. So $2.50, that maximum value minus the 45 cent credit leaves a maximum loss of $205 or $205. All right, so I'm going to go ahead and send that one out, and that will be working, assuming markets open tomorrow, of course, in the marketplace tomorrow at 45. We'll keep a close eye on it. Now, don't forget, tomorrow we're going to review all of the example trades we put on this week, including Walmart, and see if that doesn't get filled. So we'll keep that in mind. Now, when anytime selling a call spread or a put spread, remember there are short options, long options involved. Short options can be assigned anytime, but they're more likely to be assigned when they get close to being what's called in the money, right? So the stock were to get up closer to that 152 level, that's something we want to keep a close eye on. And of course, if the stock ends up between 152 and 155 on expiration, of course, there's going to be some management decisions that will have to be made. That's the responsibility of any trader, any options trader, because if that short 152.5 call ends up in the money, when the closing bell rings, that position's still in place, that will be an automatic assignment, which could result in short 100 shares, right? So got to keep all that in mind. All right, that's going to do it for our example trade. Stay with us because we're going to talk about something very important to markets right now, and that's called the yield curve. What is it? How does it work? And why is it so important for long-term investors? Stay with us. We'll break it down after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome back to Your First Trade. I'm Scott Connor. Now let's turn our attention to long-term investing. And today, we're going to be discussing the yield curve, what it represents and why it's closely followed by not only economists, but long-term investors as well. Now, you'll also discover that when the yield curve deviates from its normal configuration, it could be a warning flag for investors and the economy going forward. Now, joining me to break down the essentials of the yield curve is Jeffrey Avalos, Regional Investment Strategist at Schwab. Jeffrey, thanks for joining us. And this is the topic du jour right now, Jeffrey, because everyone's watching closely interest rates, the Fed, monetary policy, et cetera, rate hikes, everything that's going on. And of course, there's a very close focus on the yield and yield curves. So maybe let's start things off for our viewers and just define quickly what we mean by yield, and then we'll move into the curve itself.
Sure. Great starting point, Scott, and thanks for having me. So yield is the income return on an investment, such as the interest received from holding a security. It's typically, for most investors, it's expressed as an annual percentage rate based on the investment's cost, its current market value, or its face value. So real quick example, consider you have a treasury bond with a face value of about, we'll call it $1,000, that matures in 1 year to make it easy. So a $1,000 treasury bond maturing in 1 year pays 5% annual interest. Its yield is calculated as the 50 that you receive divided by the $1,000 face value, which gives you about 5%. This, by the way, is also known as the nominal yield. Again, you're just taking the annual interest earned divided by the face value of the bond, Scott.
Got it. Okay. So, yeah, that does make sense. That's fairly simple mathematics. Again, I always cringe when it sounds like it's getting too complicated. But that's pretty straightforward. Just take the value, what it is, the $50 that was earned in interest over the face value of the bond, or maybe you could call it principal, and that's, of course, that's 50 divided by 1,000, that's 5%. Okay, got it. Pretty straightforward. Now, as far as yield goes, now that we understand precisely what that is, let's talk a little bit about how yield works over time, Jeffrey.
Yeah, well, yield over time. So when we're looking at it historically, this is in most times, investors are demanding a higher yield for longer term bonds. And that's because you need compensation for committing investment dollars over a longer term where you've got more risks that are unexpected, like inflation, possible rate increases could occur. Now, conversely, short-term rates on treasuries are typically lower in yield. The difference between this short-term and long-term bond yield is also referred to as the term structure, which will form the basis of the yield curve, Scott.
Okay, so to understand yield curve, correct me if I'm wrong, you need to understand term structure. Got it. So yes. Shorter term bonds have lower yields because you're locking up the money for just a short period of time, maybe 3 months, 6 months, a year, whereas a long-term bond might be 10 years, 20 years, 30 years. You would want a higher yield because you're locking that money up for a much longer time, and a lot can happen during that period. So that makes perfect sense. Now, let's get down to the yield curve itself, the main point for us here today. Let's define the yield curve for our viewers.
Sure. Well, just real quick, the yield curve is just a graphical representation which plots the yield of all Treasury securities over time. Typically, the curve slopes upward, reflecting the yield term structure that we just discussed, Scott.
Yeah, that makes perfect sense. So if you put time on the horizon of the graph, the horizon bar, the horizontal bar, that's as you go out over time, you should see on the left side of the graph the yield, and it should go higher over time, right? So the 30-year bond should be higher than the 20, and the 10 should be less than the 20, et cetera, et cetera. So that curve should just slope up, and that makes perfect sense. Now, so that's kind of the normal condition, right? So we get that now. Jeffrey, let's talk about what also has been circulating a lot about what we call downward curves, when it's not sloping up like it normally does, or even goes to a point where it inverts. Jeffrey, fill us in on why this is important.
Yeah, happy to. So the downward sloping yield curve, in which, like you said, the short-term yields are exceeding the long-term yields, are somewhat rare, and they reflect the expectation that slowing growth may prompt the Fed to cut rates. Now, when this happens, it's referred to as an inverted yield curve, and they have a decidedly negative connotation on Wall Street. having frequently preceded recessions in the recent decades, Scott.
Okay, so this is where the red flag comes in, right? So when that normal curve is not what we're seeing, and again, it doesn't necessarily have to be inverted, but it could just like start to flatten out, right, Jeffrey? And again, that's what we're seeing a lot now is a flattened yield curve. And that's what it has to do before it inverts and actually goes the wrong way, where short-term rates are higher than long-term rates. So let's talk a little bit about these curves. In other words, when they start to flatten or invert, and historically what that has meant for markets, Jeffrey.
It's not great, Scott. So the inverted yield curve, it was first coined as a recession indicator by financial economist Campbell Harvey of Duke University back in 1986. Now, although it's just a theory, this idea has held true for the past 6 decades and 7 recessions, with only one false positive. Now, interestingly enough, Scott, the gap between the 2-year yield and the 10-year yield, although just briefly, did actually invert this Tuesday for the first time since the 2020 recession.
Okay, so we're at that point right now where we're seeing these yield curves flatten and, as you mentioned, just briefly inverted. So maybe they're running that red flag up the pole right now, Jeffrey, or maybe it's a yellow flag right now. Maybe I shouldn't say red, but nonetheless, people are focusing on that. And now I totally understand, our viewers should as well, why this has become such a focal point. I want to also mention one other thing, Jeffrey, is that you mentioned Harvey Campbell. And Campbell Harvey, I'm sorry, I got it backwards. He was just on the Market on Close today with Oliver Rennick, and interesting, talked all about inversions and yield curves. So from the father of the curve itself, he was on our program. If you want to see that, anybody can go to tdameritradenetwork.com and just click on shows, go to Market on Close, and you can see his interview. It was pretty interesting. All right, so let's talk a little bit about the history of this inversion and what happens. And I guess maybe we'll stay with the 2-year versus 10-year, Jeffrey. Does that sound good?
Yeah, that sounds good. Okay, so that's what most people, economists and analysts are watching now. An inversion of the 2s and 10s has signaled every recession since the 1950s, according to Principal Global Advisors. Now, that's true of the early 1980s recession that followed former Fed Chairman Paul Volcker's inflation-fighting efforts, the early 2000s downturn marked by the bursting of the dot-com bubble, the 9/11 terrorist attacks, various corporate scandals, as well as the Great Recession triggered by the global financial and housing crisis, and even most recently, the brief 2020 contraction fueled by the pandemic.
Well, there you have it. There's a history of an inversion preceding several of the example recessions that you just talked about. So again, it's a focal point now. Now, of course, the million-dollar question is, how long after it inverts would one typically expect to see some sort of recessionary type behavior, Jeffrey?
Well, you do still see some positive performance. For example, in 1989, stocks rose more than 30% before the recession started in 1990. Similarly, in 2005, the markets rose more than 25% on the S&P. It took 2 years before the recession happened. So over the last 5 decades, on average, Scott, it takes about 20 months to go by between the initial yield curve inversion and the beginning of a recession in the United States. So for instance, the yield curve inverted initially in January 2006, which was 22 months before the start of the 2007 to about 2009 recession. So you do have a little bit of time, but definitely Wall Street is taking notice.
Got it. So the takeaways here today are, okay, we understand what yield is, the yield curve. We understand what it can potentially signal, as it has historically. But the question, again, remains how long and typically before we see some sort of recession play out. And you said that somewhere around 20 months, again, but again, I'm sure there's wide variance between what those dates are. But we'll see. We'll see if it plays out again this time. Maybe the things will go back to normal quickly, and maybe we don't have to worry about it, but at least we have an idea of why everyone is focusing so much on this yield curve. Jeffrey, it's always a pleasure having you here and helping us understand what can potentially be complex ideas and make them so simple. Again, look forward to having you back. That's Jeffrey Avalos again, Regional Investment Strategist at Schwab. Thanks, Jeffrey. All right, stay with us because I'm going to come back and wrap up not only what happened on the markets today, But how do we end this first quarter of 2022? Stay with us. We'll break it down in just 1 minute.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. I'm Scott Connor. Now it's time for the market wrap. What happened on the markets today, what stocks are on the move, and what kind of economic data may have had an effect on the markets as well. Let's start off by looking at the 4 major indices today, and they were all lower. Now, for the second day in a row, we saw all 4 major indices a little bit lower. This is definitely a trend change that we've seen. Remember, the S&P 500 previous to these 2 down days was up 10 out of 11 days on quite a run, but you can see most of the indices today down between 1% and a little over 1.5%. So not huge moves, but again, a little bit weak going into the closing hour, which raised a bit of concern. Now, since today is March 31st, end of the quarter, where do we stand right now? Well, let's take a look at some of the indices, what they did, and where they finished the quarter. Now, the S&P 500 was down as low as 14% at one point, finished down just under 5%. Dow Jones was down 12%. Finished down 4.5%. NASDAQ was in what we call bear market. It was down 21%, but it finished the quarter down 9%. And the Russell, which was down 17%, finished the quarter down 7.8%. All right, what happened today? Well, commodities, let's look at the oil numbers and what happened there. Oil was down today, down to as close as 100 during the day. President Biden had announced that we'll be adding $1 million to the pool coming from the strategic reserve. So that put downward pressure on oil and RB. What about gold? Well, gold moved slightly higher today. Not a big move, up about $3 on the day, but less than 0.2%. What about the 10-year yield? We just finished talking about yields and rates. 10-year yield slightly lower today, down to 2.32. Remember, a few days ago, touched as high as 2.50. So definitely has backed off a little bit. And finally, let's look at VIX. The fear index itself, that was a little bit higher today, closing about 20.5. And I don't want to leave out Bitcoin. That did slide just a little bit today. Bitcoin finishing down around the 4,700 level. Let's see, 45,875. So it did move a bit lower today. Now, what about some stocks and sectors that were on the move today? Well, let's start off with the financials. They were the weakest today. Of course, we're seeing interest rates a little bit lower. That's always a headwind for the banks and financial companies. Some of the big names there that were down today: JP Morgan, Bank America, Wells Fargo, Citigroup, PNC, all of these stocks showing losses on the day. And again, no big surprise there. We're seeing interest rates come down a little bit. Now, what sectors were actually showing, where else do we see weakness? Well, let's look at some of those FANG names that we talk about all the time. Again, today that sort of included the communication services sector and the consumer discretionary sector. But take a look at some of these names across those two sectors and look at some of the down moves that we had, starting with Meta Platforms, Facebook down 5.5%, Apple down about 3% on the day, Amazon down about 2% on the day, Microsoft down 1.7%, and Alphabet down about 2%. So we saw a little bit of weakness, of course, across that sector. Some of the other names that were heavy in that sector: Home Depot, Nike, and DIHI. So, all right, that's it for the sectors and stocks. We did have a couple stocks that were on the move today. AMD down significantly on a Barclays downgrade. But we did see the cruise line sector show some strength today. CCL showing some good movement to the upside. So with commodity prices, particularly energy costs coming down, that's definitely a tailwind for those groups. As you can see, CCL up on the day. Now, what about some data today? Well, we were waiting for jobless claims, and those did come in today. Jobless claims came in a little bit higher than expected. We were looking for 197,000. It came in 202, but again, not too far from what's expected. And the 4-week average now is about 208, so that's a good number. What else do we get? We got personal income and outlays. Now, as far as income goes, came in as expected. 0.5% versus 0.5% was exactly what the number was. But the outlays were a little bit lower. So our consumer spending, well, maybe not for the month of February, which is what this data represents. We were looking for a 0.5% increase in the spending or the outlays. That came in at 0.2, so a little weak there, particularly when you compare that to what January was an increase of 2.1%. All right, well, that's going to wrap up the action on Wall Street today and for the end of the quarter. Thanks again for joining us, and don't forget we're back tomorrow at 4:30 Eastern Time to wrap up the week and review all of our example trades. We look forward to seeing you then.
Here on the major market averages as they try to clock in the third winning week. We'll have an oil story for you, but take a look right now at the major averages as they are turning into the green as oil is falling. The Dow is at 89 points to the downside at 35,139. The S&P 500 down fractionally at 4602. The Nasdaq gaining, though, up 12 points, 15,082, and the Russell is up almost
market side overlook. This is Fast Money. I'm Melissa Lee. Tonight's trader lineup: Dan Nathan, Bono and Ison, Brian Kelly, and Pete Najarian, co-founder of MarketRebellion.com. Ahead on Fast is everyone who wants a TV or phone or PC basically have one. A startling headline from Taiwan Semi that is sending shockwaves through the consumer electronics industry and rattling stocks. Plus, all that glitters and glows. Gold up more than 6% this year, its best quarter since 2020, while uranium surged even more, up nearly 35% this year. How long will this commodity climb last? And later, from the doghouse to the penthouse, we will look at stocks that started the year in the basement but have clawed their way back to the main floor. Are they worth a look for the rest of the year? We start off with a late-day sell-off to close out the first quarter. The S&P dropping steeply in the last hour of trading, bringing its losses for the year to nearly 5%. The continued volatility comes as markets brace for the next round of earnings season. And if early looks are any indication, we could be in for a rough ride. Today, retailer H&M reported a steep slowdown in sales just in recent weeks due to the war in the Ukraine. Revenues growing just 6% in March compared to 23% in the quarter before. We told you yesterday the RH CEO likened the current environment to the Bear Stearns collapse. So if markets priced in the earnings season ahead, the performance in the first quarter, Brian Kelly, was that discounting maybe the lack of visibility that companies will have in the second quarter, or is there more pain to come?
You know, I think there might be more pain to come. I mean, at least in terms of, if you look at analyst estimates, they have not reduced their estimates on the S&P 500. They haven't reduced their estimates on stocks at all. You know, we've had Mike Wilson on, and this is one of his main arguments, is that stocks have not priced in this slowdown in growth. And some of the more high-frequency data points that we're getting. We saw China PMI come out, and they're in now contraction. We know we're having lockdowns there. We know that Europe has got massive inflation problems as well as issues with the economy slowing down. So all of those things combined, I do not think this market has priced that in. And I think that is the big risk for the market here, because we have seen no analyst downgrade. We shouldn't say no, but we haven't seen many analyst downgrades at all.
Yeah, not materially. If you think of S&P, the consensus for S&P earnings for this year, it's up expected to be 8-9% year-over-year growth at $228. And that places an S&P around these levels at about 20 times or so. Now, that may not seem that expensive, especially what we got used to in the age of QE, but it is above, you know, the 10-year average, about 17 times or so. And I'll just say this, you know, FactSet, they put out their earnings insight every Friday, and John Butters, who I've been reading him for years, and it's really interesting, he suggested that Q1 consensus estimates have been lowered about 1%, you know, and then the back half have actually gone up a bit. And so to me, I just think if you're playing for that, you know, back-end loaded sort of 2022, when we were supposed to really be inflecting as a global economy right now, that doesn't really make a lot of sense. So then if you consider yourself, okay, rates are really not going meaningfully below where they are right now, and you say to yourself, given all the uncertainty that we have about the global economy and the pace of the reopening, well, S&P earnings are likely too high. They're probably going to come in, this is my guess, I'm not an economist, I'm not a strategist, but they're probably going to come in mid to low single digits at best, is my perspective. So then what's happened? How do you correct for that? Well, the stock market likely has to come in, right, if estimates have not come down yet, and that's probably what is going to be the result of Q1 earnings and Q2 guidance.
I mean, there are two potential pain points coming for us in a couple of weeks when earnings season starts, Bonawyn, and that is, you know, what has happened in recent weeks as the quarter closed. Did we see that slowdown that H&M was talking about across various businesses and industries? And then also, what is the visibility going into Q2 and the rest of the year for that matter? But I'll even just say Q2. What is the visibility even just for Q2? That's kind of difficult too.
Yeah, I would agree. Given all the geopolitical unrest and uncertainty, we really just don't know. Add in the inflationary factors that we're seeing, and we're talking about the recent or abundant readings that we're getting in terms of short-term pulses on the market. You know, we're going to get our backward-looking numbers. And what you've seen with shares, or even when they've had strong numbers in previous quarters, if the guidance is anything but stellar, the stocks get punished. So, I mean, this happens one of two ways. Either you have multiple expansion and that kind of subsists and continues to buoy the market up, given what might be a drawdown in earnings, or you're going to see a stock correction. As you know, I've been in the short-term bear camp. I haven't really bought into this bear market rally, and I think it's kind of time to pay the piper.
Are you in the bear camp too, Pete? I asked you that because, you know, the other thing that Dan had mentioned was the extent of lockdowns and what we're seeing in Shanghai right now. We already heard from Tesla today extending their production shutdown for longer because the shutdowns are going for longer. There are empty malls in Shanghai. The gleaming malls of Shanghai completely empty. No consumers there. Have we factored that in?
Well, I can tell you this. I think everybody's right when they use the word uncertainty, because that is exactly what we're facing right now. Also inflation. So those are definitely headwinds that we're looking at. Am I in the bearish camp? I'm probably not, and I know Dan probably knew that before you asked. But I certainly am in the camp that I've been a lot more cautious than I have been in the past, Mel. For instance, I'll give you a great example. I have not found opportunity to buy stocks in the portfolio even when we were at the lower end of what's been a pretty interesting first quarter of the year, just because I'm just not convinced. And because of that, I'm doing a lot in the options world, but I'm doing very, very little in terms of longer term. And when I say that, if I were a little bit more bearish, I probably would have been looking for stocks that I thought made a lot of sense on some of this sell-off. I've not been able to find that. So I remain very cautious, but it is a great trading environment. I really don't know that I've seen a better trading environment since I've been a trader since 1992. So that gives you a little bit of an idea. I mean, this has really been remarkable, whether you're talking oil one day, technology the next, semiconductors the next. Oh, and then, by the way, you can go over into the uranium space. Wherever you want to go, there have been incredible opportunities for trade. But that being said, I still think you have to be very cautious.
Yeah, no, Pete makes a really good point. It has been an amazing trading market for a whole host of different risk assets. I mean, it's not just stocks, but when you think about the stock market, you think of some of the bounces. I mean, we use terms like bear market. None of us know what that really means. It happened so quickly in Q1 of this year, and the last one that we had, which is defined by a 20% peak to drop decline, happened in Q1 of 2020, and that corrected itself, meaning got back to its place very quickly. I guess what I would really focus on is that we still have this condition where about 10 stocks are buoying the major averages, right? So if you look at, on the quarter right now, on the year, Apple is down about 1%. The NASDAQ is down about 9.5%. If you look at the outperformance that we've seen of Amazon just this year, and I know it underperformed last year, but those major names are really masking what continues to be a lot of really bad price action across a whole host of sectors. Now, we can talk about energy, we can talk about all those stocks up 40%, but they make up low single digits percentage of the S&P 500. So if those handful of names are going to continue to do the heavy lifting, then there's going to be a lot of continued weakness in the other ones. And a lot of stocks that had rallied 50% off of their lows that are still off 50% from their highs, that trade, have a ball, trade them. I mean, they're going to be great if you're nimble enough and you use options the way Pete does and you do all this sort of stuff. But most people don't have that. And I'm going to tell you this, when you go 50% from a low after declining 70 or 80%, and then you go back and you retest those prior lows, it's lights out, people. I mean, that's it. There's no hope for some of those names going forward. And so we've seen this in the financial crisis. We saw it in the post-dot-com crisis. So I guess the point is stay nimble if you're going to trade, but don't fall in love with trades, because when some of those things that just rallied the way they did go back and make new lows, you're going to end up owning those for a very long time.
All right, we got some breaking news here we want to get to. On Amazon's union vote in Alabama, Deirdre Bosa's got the story. Debo.
Hey, Melissa, we do have some early results from that Alabama warehouse. Remember, this is the second election, and it is much closer for the unionization side. 875 votes in favor, however, 993 against. Last year, they lost by an over 2-to-1 ratio. So the results are getting closer. There's more than 400 challenge ballots, so they need to sort out those before we get a final result. Remember, too, that there's another union vote being counted in Staten Island, and that shows at the moment that the union there has the lead, but they are still counting. We should get the results tomorrow. The takeaway, though, Melissa, is that unionization, the drive at Amazon, is gaining some momentum. We'll bring you more as we get it.
All right, Deirdre, thank you. Deirdre Bosa. And it's gaining momentum for other companies as well. I mean, Starbucks has a number of stores and regions vote on unionization, Pete, and to me that spells higher wages, good for the consumer, good for the workers there. How do you think it affects the shareholders, though?
Well, and I think that's why we've seen certain stocks that we really love and we know we use, and we know that we see lines out the door, and we all know about Amazon. But I think that's right, Mel. I mean, when it really comes down to it all, these are going to be impactful, I think, to those companies going forward, which is why you look at Starbucks. Starbucks, remember, everybody seemed to love it when it was like $130 a share, and then suddenly nobody seems to like it when it's dropped back down. So I think that's partially because of the nervousness of what is it going forward and how is this going to impact their earnings as we look ahead. And the fact, of course, that in China, things, which is where their growth was really coming from, that was something that was shut down. So there's a lot of different headwinds that we're talking about here right now. But this is certainly something that I think everybody's been watching very, very closely, whether it's Starbucks or Amazon or others, where this is something that is going to be impacting what we're all going to be looking at in the forward markets. And that's what we're always looking at, right? We're never looking behind. We're always looking ahead. And that is something looking ahead that I think a lot of people are very nervous about.
Yeah, but looking back at the conversation we just had, I mean, wages here in the U.S., this is a big part of corporate earnings, right? So if you're worried about a stagflationary environment and you're worried about things like a wage price spiral, that's the thing that's going to weigh on earnings. Those are the things that are going to kind of, cause strategists to kind of rework some of those numbers lower. The only thing I'll just say is that if you're expecting all their growth from some of these U.S. multinationals, they're not having some of the same wage pressures as we are. Deglobalization is going to hurt them, and it actually make them even that much more competitive. And I'll take you back to prior to the pandemic, we were worried about automation. We were talking about universal basic income. And I guarantee you, all of these gains of these major consumer-facing companies, what they've been spending on is investing in AI. That's going to go back to automation. I'm just saying, I think it's going to be a smaller component of the workforce that's going to have the benefit of these higher wages once we have the pandemic and some of these geopolitical stuff in the rearview mirror. But right now, I do think this is a huge risk to corporate earnings for the S&P 500 this year.
All right, well, rising inflation and sky-high energy prices a key driver behind President Biden's announcement of the largest ever release from the Strategic Petroleum Reserve, 1 million barrels per day of oil for the next 6 months. Oil finishing, though, is down, but still up 33% this year. That's its 8th positive quarter in a row. So will the commodity complex continue to grind higher? Let's bring in Ed Moore, Citi's Managing Director and Global Head of Commodity Research. Ed, great to have you with us. Great to get your thoughts as always. It seems like this is a very short-term solution. I mean, obviously, any release from the SPR is usually a short-term solution, but it also makes it less appealing, perhaps, for oil companies to actually open a spigot, so to speak, and produce more. I mean, if you're going to just all of a sudden lower the price of oil forcefully like that, you're not giving any incentive to the markets to actually pump more.
Well, it depends on how you look at it. Actually, prices are higher than anyone expected they'd be at this time of year. And yes, there are certain companies that are, dug into. It doesn't matter if oil goes to $200. We're not gonna drill more. But I think the White House has it right this time. They've talked to enough companies to know that they've incentivized them, and they talked to in the White House fact sheet about using the National Production Act of 1950, which mandates that companies produce. They didn't specifically talk about oil. They talked about metals, actually. They talked about metals that are needed for battery power, particularly for long-lasting batteries. But they mentioned it in the context of the SPR release. And in the SPR release, they also talked about how they were willing to buy back oil, and they've told companies more or less at what price they'd be willing to buy it back. So I think this has incentivized a number of companies to raise their drilling activity. We're already seeing it in the increase in drilling rates. And I think we'll be surprised to the upside. The White House is talking about, getting to 1 million barrels a day of growth by the end of the year. I think it's going to be potentially bigger than that if we look at it on a deck basis. And even on a year-on-year basis, I think we're looking at between 1.3 and 1.5 million barrels a day of incremental U.S. oil and natural gas liquid supply. That's, by the way, over and above the million barrel a day release. Yeah.
Sorry.
Go ahead.
Hey, Ed, Brian Kelly. So I'm curious on the SPR release. What we're hearing a lot is that there are diesel shortages. We saw Austin Airport warn they might run out of jet fuel the other day. So all the products are in shortage. Does this SPR release impact that? And I'm asking it because obviously that's going to have a big impact on the economy if you can't drive your truck and you can't fly your plane.
No, I think it's going to have an impact. The impact on the diesel is going to be coming from a multiplicity of factors. And we have to remember that one of them has to do not with oil, but with natural gas. So we had natural gas prices skyrocketing this year for the first time in my memory. The price of natural gas was higher on an equivalent basis than either diesel or propane. I think we're looking at parallel things that are underway that are going to reduce natural gas prices, that are going to see a switching as a result of that back to natural gas from oil. But more importantly, if you're a refiner that's upgrading heavy oil or upgrading sour crude, you need natural gas as a feedstock. And a lot of that shortage is, in addition to the high price of natural gas and switching to diesel, a lot of that is also the inability to run refineries, particularly in Europe, which is normally short diesel, and where refineries were uneconomic, even with diesel cracks at the $30 to $35 barrel range. So I think we're going to have compensating factors for that are going to ease the diesel market as we get into the summertime.
And if we can quickly touch softs, I'm curious what your outlook is for some of the crops outlook, I mean, in terms of next year, because right now we're seeing crops that are not being planted in some parts of the world because they cannot be planted, crops that are being changed to use less fertilizer intensive crops instead of, say corn, which may require more fertilizer. And I'm wondering what the longer term impact is that the consumer can look forward to.
Well, the longer term impact in crops is usually 18 months. Because that's about as long as it takes to get from one cycle to another. But we're in this unusual circumstance in which Ukraine and Russia together are close to 30% of global wheat production. Corn production is significant in Ukraine as well. It's hard to imagine how a Ukraine crop is going to be reaped, let alone sown for the next season. And we're seeing a big impact already, particularly on emerging markets. We think of food prices where we live, but we have to remember that all of that turmoil in the Middle East in 2011, the so-called Arab Spring of 2011, was due to a wheat shortage, and that wheat shortage came from Ukraine and Russia. And we're very much in a mode to have that happen. And with the economic restrictions that are imposed one way or another, Russia being a very large, the world's largest exporter of fertilizers, we're seeing problems ahead this summer. And I think we'll see that on the inflation side. We're seeing deflationary efforts underway on the energy side, but there's not much to deal with the inflation on ags. And we're worried about the political turmoil that might result, just as we saw that political turmoil in Egypt and Tunisia in 2011.
Wow. Ed, thanks so much. We appreciate it. Ed Morse of Citi. We do want to turn your attention to the 2s-10s spread. It has gone negative. So right now the 10-year yield is at 2.337 and the 2-year is at 2.339. We thought we'd bring that to your attention. That's something we're watching. Obviously, this is a moment in time right now. We'll see if this sticks in terms of the inversion of the yield curve. Brian Kelly, I thought it was really interesting what Ed mentioned, Arab Spring. I mean, 2011 seems like 3 lifetimes ago. But yes, a wheat shortage caused that, and we could be in for more of that to come in the year or two ahead.
Yeah, and I don't think it's going to be isolated just to the Arab world or to Africa. They're certainly going to get hit the hardest, unfortunately. But you had mentioned there's a lot of crops here in the U.S. that they're switching. So we might have a corn shortage here. It might be something in soybeans, something we haven't thought about. Or maybe it's livestock that aren't getting the feed that they need. So there are all these unintended consequences that I think we're going to see in the fall. And you have to be worried about it. So there's a couple ways to do it. You can trade ag, or you can buy yourself one of them deep freezers and get a whole bunch of meat like BK did.
I love buying in bulk personally, Bono, and I think that's one way of doing it. But for somebody who lives in a small New York City apartment, you're probably just going to pay higher prices. And unfortunately for the consumer, they're paying higher rents, which are sticky, right? Even though they're getting a higher wage, which is sticky also. But in terms of inflation, there are all sorts of inflationary pressures which won't be alleviated and may even get worse as time goes on, like food.
I mean, you hit the nail on the head. I mean, outside of food, I would point to rents. I mean, those are pretty much fixed costs, and without much wiggle room there, I really, again, I think it's a cautious outlook at best.
Yeah. All right, coming up, a chip dip, a big warning from one semi stock, what the company is flagging in consumer demand. Plus, the R word, inflation and rates in focus as the major indices post their first quarterly loss in 2 years. So what is next for stocks? We'll break it down when Fast Money returns. Welcome back to Fast Money. Check out shares of Gamestop surging in the after-hours session. The company planning a stock split in the form of a dividend. Stock is up 14%. We've seen this, Pete, time and time again. The company announces a stock split. The stock goes higher. In this case, this is really interesting because we've said before that this really impacts options trading. And this is a stock that people like to trade the options for.
Right. And it was pretty interesting today, Mel, because the majority of what they were buying, this is not totally unusual. The majority of what they were buying was in the front month, but not only in the front month, but it was specifically on the call side. That's not totally unusual, but 71% of all the trades today were on the call side. And the interesting part about it was, as we're going into the final day, obviously tomorrow is expiration, we look at the 170 strike, about 8,000 or 9,000 of those were bought. The 180 strike, we also see about 12,000 of those being bought, and 16,000 of the 200s. Now, honestly, like, why are they buying those going into this point in time, other than the fact that maybe somebody had some form of word, some sort of something out there that had everybody going for these options? That was pretty interesting. I thought that close to 50,000 options were trading between 170 and 200 to the upside, and the stock, of course, in the after hours is trading pretty nicely, about 190 what? 196, 197. I'm not looking at it right this moment.
192.
But I'll tell you what, those options, okay, well, those options, they will start to move pretty quickly then. Those 180s, those 170s, the 190s, those all start to move, maybe even kick in the 200s depending on where we are tomorrow. So it really is pretty interesting to watch how this whole game is played, and GameStop being the name today.
Eyebrows raised, Bonawyn, are yours?
Definitely eyebrows raised, and I think he calls out some really good points. That gamma squeezing or kind of rushing to those upside calls. I mean, I don't really understand it in like a one-day option, but it is pretty much textbook. Pretty much has been the playbook for these meme stocks, and I think the split will only make that a more readily available trade. So I think it's a boon for retail investors. We all know that it's not value creating, but it tends to lead to higher prices.
All right, we are just getting started here on Fast Money. Here's what's coming up next.
The R word. Investors fearing the worst as the markets post its first quarterly loss in 2 years. But where do stocks head next? Plus, pedal to the metal. Gold glitters as uranium shines. So how can you get in on the metal mania? The traders break it down next. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money. Chips getting checked today. Shares of Taiwan Semi dropping more than 2% after the company said it is seeing signs of slowing demand for smartphones and PCs. Meantime, AMD dropping more than 8% after getting a downgrade over at Barclays, the firm citing risks to its PC and gaming market in 2023. Is this pull forward, Dan?
Well, maybe. I mean, the fact that we're still talking about lockdowns now we're in Q2 of 2022 is pretty shocking. You look at a company like Taiwan Semiconductor, they came into this year in January. They had raised their sales guidance. They had announced that they were going to maybe spend up to $44 billion in CapEx. Apple is a 25% customer of this chip maker here, and so you have to think about what are the reverberations here. And so, this company's going to report in a couple of weeks. So, again, do they have to actually, do they miss that guidance that they just gave? Do they guide down for Q2? These are the sorts of things that should be kind of weighing on the broader market. A stock like this is down 30% from its recent highs, but look at the SMH and the rally it just had. This is one of the largest components there. So I think the major indices or some of these ETFs where stocks like this are large components have not caught up yet.
And then longer term, I mean, if you think about the political risks involved to Taiwan Semi and others, BK, if there is a move to reshoring and that actually sticks, that could benefit the chip industry here if that gets underway and the political tensions with China continue.
Yeah, and I think we're going to see that. I mean, I'm old enough to remember when there was actually a chip shortage, because that was last year. So I can still remember that. And it's funny how we've kind of flipped here. But also remember, chips are very cyclical. So this may be an early warning sign about what's going on in the economy. Like we said, we already know China is contracting. So are we starting to see the early signs of economic slowdown globally? And are the chips the canary in the coal mine? I think you need to pay attention to it at the very least.
I mean, so you're hearing it from chips, sofas, RH, crop tops with H&M, Pete. I mean, the list is starting to grow and it's going across industries here as the show goes on.
I got to the crop top part of it threw me off a little bit, but yeah, no, I get I get what you're saying. And you know what? When you listen to RH, they talked about how the pricing is going to have to go higher. And so when you start hearing that, do they have the same kind of pricing power that there are in other types of businesses? I don't think so. So because of that, yeah, I think that this is something that we all have to make sure that we are paying close attention to this whole thing, Mel, because this is something that is going to get worse before it gets better.
Bonwin, give me a trade on a chip maker.
Long term, I actually like the Intel story for all the reasons that you just mentioned in terms of domestic production, ramping up foundry ability and manufacturing ability. Looking at AMD and Taiwan Semi today, I actually tend to want to rotate to a name like NVIDIA. And I know the multiple makes you want to shake your head and take a second look. But being that they have some specialized situation there in terms of gaming, and that's being viewed as an alternative to other streaming services and other consumption, I can at least wrap my mind around why that might be something that's sticking and actually has room for growth there.
All right, let's get another check on how markets ended today. The Dow dropping 550 points, all three indices falling more than 1.5%, putting in their worst quarter in 2 years. And the two-year yield topping the 10-year rate moments ago. Inversion, the I word. The move comes as Fed officials seem to be less confident the U.S. can avoid a recession. Let's bring in CNBC senior economics reporter Steve Leisman. What are you finding chatting with all those Fed folks out there, Steve?
They're obviously not predicting recession. What's really interesting to me, Melissa, is they're not strictly ruling it out. And I think that comes from two sources. The first is that there's a lot of unknowns out there. They don't really know how to process what's happening now with the Ukraine war, the extent to which vital commodities are both up in price and may even not be available. When you look at what's going on with Putin and the idea of making the Europeans pay for natural gas in rubles, it's an interesting bit of brinksmanship going on right there. The other sources, they don't quite know how they're going to get inflation under control using their two tools of balance sheet reduction and interest rates, how much pressure they're going to have to give on the economy. So, look, they say, the economy's in good shape. We'll probably get a decent jobs number tomorrow, and that the economy can take interest rate hikes. But it's really a question of 2023. Will there have to be a slowdown? Will there have to be a decline or a flattening of growth in order to really get inflation under control caused by the Fed raising rates above neutral to really tamp down on the economy?
You know what's so interesting, Dan, is that when we talk to strategists and folks that track the markets, 2023 is generally, if they are forecasting any chance of recession, it is in 2023.
Yeah.
And that's what Steve is talking about.
Yeah, and I think Steve would defer to us on the stock market. The stock market would probably discount it by the time we have that recession, especially if it's one that's actually orchestrated by design, as BK has been saying. I mean, that's really what the Fed has to do. They have to slow things down to some degree. And, I just don't believe that a 15% peak to trough decline in the S&P 500 in one quarter, well before they even started raising rates, is going to be it. That's going to be it. And so the probability of a recession, of course, it increases. It doesn't mean that it has to be attached to a bear market at the time that we actually officially know the recession is here.
Yeah, and Steve, I got to ask you how Fed officials are thinking about the inversion of the yield curve. And I know that we make a big deal out of it. It's happening as we speak right now. The yield curve is, in fact, inverted. It's a moment of time. We'll see how long this persists. But whether or not that is a contributing factor.
Write it down. According to my data, I look at the tick data, it was 4:42 and 10 seconds was the moment that the curve actually inverted. A bit of a false alarm a few days ago when it actually got to zero. But yeah, it really inverted minus 0.1, minus 0.2 at 4:42 this afternoon in the after hours. As I've said before, Melissa, the Fed likes to look at more of a near-term curve. It likes to look at the 3 month to 2 years, sometimes 3 month to 10 years. It's more interested in the information given by the markets over the time period that they're trying to forecast. There's also some economic analysis that shows those near-term curves do a better job of predicting growth and forecasting growth. But they're going to look at the 210. They know what the record is of the 210 predicting recessions. They're also going to look at a variety of different spreads that are out there. The investment grade, non-investment grade spread strategy, look at mortgages to see what's happening to financial conditions. That's their big interest in the fixed income market. How much restraint is being exercised on the economy on the one hand, and then of course they're concerned about whether or not balance sheet reduction and those sorts of things creates dislocation in the market, such as they're going to have to ease up and are going too fast.
All right, Steve, always good to see you. Thank you. Steve Leisman. Brian Kelly, I'm going to ask you this question, and it's going to sound flip on my part maybe, but do you care what Fed officials see in terms of recession? Because they got the inflation part of things wrong. And I don't mean any disrespect to Fed. It's very difficult to forecast. Let's put that out there. I don't forecast.
Yeah.
so it's easy for me to criticize.
Exactly. Well, as Yogi Berra says, predictions are hard, especially when they're about the future. However, I would say that the Fed has a huge credibility problem. It was less than a fortnight ago that Powell was on TV and he said, hey, listen, I think the odds of a soft landing are pretty good. Now, all of a sudden, this story leaks out that maybe they're going to be looking for a recession. JP Morgan had a report out today that Bank of England might need a recession. So clearly there was an email that went around and said, hey, listen, we need to start preparing the ground for the potential of a recession here. My view is that's exactly what they want. You cannot fight the Fed in this environment, which is what makes me a lot more cautious in this environment. They do not want asset prices to rip higher. They don't want the economy to rip higher. They need things to slow down. In my book, that's a recession, and in my book, that's coming.
All right, coming up. Metal mania, hard commodities rallying to close out the quarter. Gold, silver, nickel, all on the rise. We're hitting that trade next. Plus, with Q1 in the books, we're checking out some of the comeback kids, the names of some big moves off their lows. Don't go anywhere. Fast Money's back in 2.
Get your trades to go with the Fast Money Podcast. Catch us anytime, anywhere. Follow today on your favorite podcasting app. We're back right after this.
Welcome back to Fast Money. Oil and ag, not the only commodities posting big gains to start 2022. Gold up more than 6%, finishing its best quarter in 2 years, while uranium soared nearly 35% in Q1. Palladium, also a big winner, up nearly 18%. So can these commodities keep climbing? What's your favorite metal, Brian Kelly?
Wow, I've never been asked that question before. You know, my favorite metal is probably, let's go with a favorite rock. It's probably like uranium, right? I think that really is a great trade at this point in time. There's a couple different stories there. You've got a new, relatively new ETF-like product out of Canada called the Sprott Uranium Trust that is buying uranium. That's something that I'm long. As well as when you look at the energy grid across the world, you look at Europe, they're going to have to turn their nuclear power plants back on. They're obviously going to need fuel for that. And then as we get to more of an electrified grid, the story for uranium even gets better because it's the only energy source out there that even comes close to hydrocarbons when you talk about energy efficiency. So to me, the story for uranium is fantastic. I don't know if uranium is shiny. It's just yellow, right? So
Yeah,
that's what I've always said is you can't go green without yellow.
And you need some blue, too, but that's a minor detail. Pete, I think you're all hopped up on the uranium trade as well.
I am. I'm right there with you, BK. I love it. I've been loving it this year. It's been nothing but hitting almost on a daily basis. We see different names all the time, whether it's Next Gen or it's UUUU, which is an energy play as well that's also uranium. It's also CCJ, Cameco, has been hitting almost on a daily basis, hit twice today for us for unusual option activity. So the movement that we're seeing out of uranium is certainly huge. Lithium is another one where we're seeing more and more of that along with copper. And I think a lot of that has to do with the EV space, Mel. So I think when you look at those definitely stand out. But you did mention gold. And I will say, I like GLD, I like GDX. I'd like to be in individual names a little bit more. But those have been an area that I've found a little bit of comfort in. Because when you're looking around for something to be able to be a little bit safer place, maybe gold's that play, and that's why I have some positions on there as well.
You know, Bono, and I know you've traded solar in the past, and I'm wondering how you view the commodity spike because it's delaying or canceling a lot of projects that had been underway because you need a lot of copper and other metals in order to put in these installations.
Yeah, it's just definitely causing disruption in terms of inputs. You know, I'm still bullish the secular trend, and I think that given where we are with a lot of other base commodities, particularly crude and other distillates, it serves as, you know, a good substitute along with the rails. So I think maybe supplement the position a little bit with the rails, being that they just don't have the same challenges in terms of input costs. But ultimately, as you've seen, you know, Biden come out and say they want to make this shift. And if you look at everything from, you know, your local transport authorities to the federal government, you are seeing this trend here. And I think that trend will tend to hold. And after we get through this, I think the shocks to, you know, the base commodities will only accelerate that.
All right, coming up, call it a comeback. The names have made some big swings since their quarter lows. But are they still worth owning at these levels? We'll find out next. Plus, crypto in vogue, the staggering stat on who is trading digital currencies. The number ahead. And Fast Money returns. Welcome back to Fast Money. With Q1 in the books, we're checking out some stocks that early in the year were big-time ugly ducklings. But thanks to major comebacks from their lows, they are well on their way to becoming lovely swans. Check out Nucor, up 60% from its lows. American Airlines, 42% from its bottom. Eli Lilly, up 21%. And Apple, that was a 13% turnaround from its lows. It wasn't just stocks doing an about face. Bitcoin also surging nearly 30% since its lows of the quarter. So, which of these big names do you still buy even after such a big rebound? Pete, I'll go to you first.
I'm going to surprise you, Mel, because I know you think I'm going to go with Apple, but I'm not. I'm actually going to go to Nucor. I like these steel names. I like a lot of the different types of names within that space. U.S. Steel, Cleveland Cliffs. But Nucor, they've got pricing power. They just had record numbers. They've got great free cash flow, and they trade incredibly cheap. So for all those reasons, I think that they're going to be, at least for this year, 2022, I think that they are in a great position to continue to do very, very well. But I think that you have to be smart, because by the end of the year, I think you got to start taking your chips off the table.
Pete, I might surprise you, but I'm going to say I would be a seller of Apple. If you were to buy this thing, and some people bought this very well, okay? It got down to 150. It kind of held support. There's a moving average down there, the whole 9 yards, a breakout level. This thing went from 150 to 180 in a straight line in less than 2 weeks. Just do the math on that. You can forget about the percentages. It's a $500 billion in market cap. And what did we just say about the Taiwan Semi? It's a 25% customer of them. So to me, I just don't think this discounts anything. We talked about a 20 times multiple in the S&P 500 as expensive possibly. This trades at 28 times. Expect to have lower growth in the S&P 500, which could be lower than what we, ultimately when they guide. So to me, I'd be a seller of Apple.
I'm not surprised by that. I actually was going to guess Eli Lilly for Pete, but I will guess Bitcoin for Brian Kelly. Am I right?
Yeah, boy, you really went out on a limb on that one. But yes, BK is a long-term bull on Bitcoin. So I'll give you what's been going on and kind of the rationale. If you look at Bitcoin, it is starting to get correlated with gold a little bit more. So you're starting to pick up the kind of this inflation hedged narrative. So we're seeing that seep into the market. We talked a couple weeks ago about the fact that negative real rates are back, and that is generally positive for Bitcoin. And Citi had a great report out today on the metaverse, talked about that being about an $8 to $13 trillion market. If Bitcoin can capture some of that, or Bitcoin and Ethereum, you're talking about a multi-trillion-dollar market where Bitcoin's only 800 million right now, or 800 billion right now. So, long term, there's a lot of stuff here. The risk, of course, is if the Fed decides to really crush things, it's going to be hard for all risk assets. But for me, you want to have some exposure to Bitcoin.
Bonawyn, which former ugly duckling do you like?
I'm tempted to go with Lilly just because I feel like all swans deserve to be included in the discussion, and we're kind of leaving this one out. Dan makes a really good point about Apple. I have a slightly different take on it. If you look at the concentration of these names in the major indices, if you were to buy that, you're simply over-owned. So purely from an asset allocation standpoint, that's why, I think it's tough to buy that one. I also picked Nucor. It trades around 6.5 times forward PE, strong free cash flow. I think it's got about $2-3 billion of cash on the balance sheet. I don't really love the manufacturing exposure, but as Pete again said, it's got pricing power, and for those reasons, given the ducks that you gave me, Mel, I've got to shoot one, and I'm going to shoot that one.
We're not shooting anything. That's another game that we actually mothballed because we got just outrage from animal lovers out there. So we're okay. But I got your point, Bonawyn. Coming up, we've got even more Bitcoin
video gaming.
Video gaming. We've got even more Bitcoin banter ahead. Crypto use more popular than you might think. The big number of Americans dabbling in this trade. We got the details next. Plus, we are looking under the hood. Robinhood, that is, shares dropping more than 7% today, and options traders are betting on some more pain ahead. We've got the details when Fast Money returns. Welcome back to Fast Money. How's this for a big number? More than 1 in 5 Americans have now bought, traded, or sold cryptocurrency, according to a new NBC News survey, including 50% of men between the ages of 18 and 49. Still, only 19% of respondents said they view crypto positively. That's odd. Compared to 26% who say they think crypto is a net negative. Both Bitcoin and Ethereum have given up their gains for the year. BK, are you surprised by this number? I mean, to think about 1 in 5 people you run into on the street have traded crypto? Staggering.
Yeah, no, it doesn't surprise me. It's the people's investment, and it's probably the first investment and first asset class out there that the people have been in, the retail has been in before the institution has come. So no, based on boots on the ground that I've seen, it doesn't surprise me at all.
All right. Let's talk now about one of the platforms you can use to buy or sell crypto, and that would be Robinhood, the trading app getting crushed in today's session. And one option trader is making a huge bet that these losses are about to get a lot worse. Mike Coe is the action. Mike.
Yeah, so we saw Robinhood options. It traded about 1.7 times its average daily volume. It was the 14th most active single stock option by contract volume traded today. And although calls did outpace puts, bearish bets actually outpaced bullish ones. We measure that by put buying and call selling relative to call buying and put selling. And the single biggest trade we saw was a sweep of the April 13 puts. Somebody bought over 3,300 of those, paying an average of about 52 cents a contract for them. Buyers of those puts are obviously betting that Robinhood's going to decline below that $13 strike price by at least the 52 cents that they paid. That would put it below 12.5 bucks by April expiration, which is going to be 2 weeks from tomorrow.
How do you feel
Today,
about
actually.
Robinhood, Dan?
Not a fan. I mean, I don't know what the innovation is there. I would just say this, that, that short squeeze that we saw earlier in the week from 13, okay, where Mike just said that a few times, 13, 13, 13, went to 16.5, and now it's basically round trip that. That looked like a little funky trade this week where, into quarter end, high short interest, really poor sentiment. It looks like a few people got together and said, let's rip this thing. And the fact that it's come all the way down tells you that real owners of this thing are looking for opportunities to get out.
Yeah. All right. Mike, thank you. Good to see you for more options action. Be sure to tune into the full show. That would be tomorrow, 5:30 p.m. Eastern Time. Up next, we've got your final trades. Inversion is here. The yield curve is negative, and a lot of people look at this as an indicator of recession. It doesn't mean that a recession will happen, but there has never been a recession without an inversion of the yield curve. So this is something that people have been very closely watching. So we are seeing the inversion taking place in the after-hour session. We'll see if this carries through to tomorrow. Time now for the final trade. Let's go around the horn. Pete Najarian.
I'm going to give you Lithium Americas Corp, LAC, Mel.
Brian Kelly.
Well, you asked me what my favorite rock was or what my favorite metal is. Let's call it gold, like that one.
Bono and Eisen.
Given the uncertainty in the domestic stock market and globally, I'm looking long for some volatility. Take a look at the VIX.
Dan Nathan.
We got a lot of time here, don't we?
We do. So what's your
can I ask you a question? My favorite metal? I'm so glad you didn't go to me during that. Those guys covered that. They really surrounded the trade here.
I know. You don't have no favorite metal.
Well, listen, I just want to be really careful with this Apple thing. And I said to you guys when it was 160, I thought it was going to 140, and now it's 174. I really do think that some of these mega cap names will lead the market lower to retest those March lows. So to me, if you bought Apple as a trade, I think it makes sense to take some profits here because the headwinds fundamentally don't look great right now.
All right.
Yeah.
Thank you for watching Fast Money. We got a lot of tweets tonight about how negative we are, but, thank you for watching. We'll see you back here tomorrow at 5. Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job, not just to entertain, but to put it in perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How does the market roll over so easily with the Dow plunging 550 points, S&P plummeting 1.57%, and the NASDAQ nosediving 1.54%.
That was easy.
Closing out the worst quarter for the averages since March of 2020. March of 2020. Ooh, that was a great time to buy. Sometimes Wall Street gets so negative it takes your breath away. Out of nowhere, we've gone from believing the American economy is strong, maybe too strong, to now thinking it's in a tailspin. It's so bad that now people are gloomy about everything, every industry. Each day they pulverize a new sector. Today was the bank's turn with an expectation of a surge in bad loans. They have hardly any bad loans. Yesterday it was cell phones. They're red hot. PCs. The day before, retailers. Apparel. Monday it was home building. Who will be on the rolling red hot bear griddle tomorrow? All right, I think the pessimism is getting out of touch with reality. But before I explain why, you need to know how we got here. Remember, a year ago, we had no idea how our country would beat COVID. It was an odd time. Many thought we'd soon be back to normal, but every time a new strain popped up, we collectively panicked. We already knew inflation was a problem a year ago, but the Fed figured it would wait once it had to go away, right? It had to go away once we got past the pandemic-induced supply disruptions. Then the Delta variant came along. The health regulators told us to stay home, and the return to normalcy, it got delayed. Once we finally got over Delta, Fed Chief Jay Powell announced that it was really ready he was ready to stamp out inflation. It was November. But a couple of weeks later, Omicron hit, and the Fed braced for the possibility of another lockdown, which seemed reasonable given we thought that Omicron might be as deadly as all the other strains, maybe worse, certainly more contagious. That's why Powell postponed raising interest rates until earlier this month. In retrospect, of course, that was a mistake. Turns out we didn't need to worry about more lockdowns once the bulk of the population had been vaccinated. Policymakers are always fighting the last war. And for COVID, the last war was March of 2020, but who knew? Meanwhile, the pandemic has transformed the economy in ways we never thought could happen. First, unbelievably, many people who never dreamed of owning a second home decided to buy one because so many jobs went hybrid. Then they had to furnish it, burnish it, and get a car to drive to it. The whole movement was as unpredictable a reckoning, and it was brought about an empowered labor force that would rather resign than be forced to go back to work in person. Nobody's ready for that. Nobody. Who could be? It was contrary to any trend we've seen since downtowns were created. It was as though the economy went from 0 to 90 in 2 seconds. Home prices soared. Home builders couldn't put them up fast enough. Car prices galloped higher. Unlike any other time in history, the sticker price wasn't high enough. Normally it's the other way around, right? Used car prices traded over new car prices because there weren't any new cars. Now, in fairness to the home builders and automakers, many of the executives who run those companies thought we were headed into a prolonged recession back in 2020 when the pandemic first hit. Hey, the stock market certainly signaled that. They decided to throttle back all their 2021 ordering. Ooh, that's where it went wrong. Because we're talking about throttling back orders for tools, washing machines, carburetors, gasoline, semiconductors. So here's what happened. Everyone got it completely wrong. Every single judgment made has been upended. Much of it, again, because we embraced a new form of work, hybrid. The rise of remote work may be the most important economic transformation in my lifetime. And again, I don't want to blame Jay Powell for missing this, because everyone missed it. The auto companies cut back production when they should have increased production. The home builders need to put up as many homes as possible, but they put up fewer. We should have been building semiconductor plants left and right. We built none. Meanwhile, the oil companies got fed up with the boom and bust nature of their business, so they decided to be prudent for once and cut back on their drilling, something President Biden chastised them for today. I doubt they care. These companies are finally making way more money than they used to. Little political heat from the White House won't matter. The makers of every part that goes into every car or a house are cutting back, right when they should have gone into overdrive. Finally, we even seem to run out of food. In the end, we needed far more workers and far more basic materials than we were able to produce or were willing to produce. At the same time, between COVID and a major change in the tax code, we've seen a massive migration from cold, high-tax states to the warm, low-tax states of the Sun Belt. And so that's created a severe labor shortage in the manufacturing hubs where we most need workers. I mean, it's totally upside down. Everything was already getting really out of whack. And then, out of nowhere, Russia invades Ukraine in a war that has many on edge. Between the deaths and the photos and the threat of nuclear annihilation, Wall Street psyche was shattered. We know from the RH conference call that even the high-end buyers are shaking. We're now stuck with a truly unhealthy development where everything has gotten too expensive for regular people at the same time that the Fed needs to slam the brakes on the economy to stop the inflation process, create some unemployment. But just when the Fed is swinging into action, I think the invisible hand of the free market seems to be taking care of a lot of this. Let's tick them down. Mortgage rates have gone sky high versus where they were just a couple of months ago. Homes have gotten so expensive that the home building stocks have peaked, anticipating that home prices will soon follow. The auto stocks have tumbled too, signaling that they finally can make enough cars and trucks that prices have peaked and will go lower. The hybrid office in your second home that fuels remote work, it's fully built out, whether it be from furniture, from Williams-Sonoma or RH, or whether it be from PCs. No more need for tools or Whirlpools or even Home Depots. Now, last bastion, we find out these home offices, they've got everything they need. Suddenly, the conventional wisdom says there's too much of everything. So prices are going to come down. Stock prices are anticipating that. And that's why the only sectors that sustained rally in the first quarter were the oils, because they've cut back, and the utilities, which really act well only when there's going to be a heavy recession. Now, let's back up for a second. Remember how wrong we were last year when everything in the stock market got bid up too much right before the Fed declared war on inflation, in word, if not in deed? Back then, we overshot to the upside. And I could argue that the stock market's now overshooting to the downside in the same fashion. While we still have an inflation problem, today's action is predicting a crash in sales for pretty much everything and a lot of bad debt. I say for now, just let it keep coming down. Except that there'll be plenty of stories about, say, how AMD will have too many chips, or GM too many cars, Lennar too many homes, Home Depot too much inventory. The president now saying we need more oil. Maybe he gets his way and we'll have too much of it. Well, that'll be a tough one. The Fed will definitely raise interest rates, maybe many times. Declines will accelerate, and inflation will definitely be tamed. Most importantly, the market will have anticipated all this and will bottom well ahead of everything that I just described. So when does it fully get baked in? Okay, I'm not sure. But the bottom line is that we price in this negativity far more quickly than you think. Maybe it takes a month. Maybe it only a few weeks, but it will happen. And once it does, we will be poised for one incredible, tremendous rally. Kumlesh in New Jersey. Kumlesh.
Hey, Jim. Great show.
Thank you.
Jim, my question is about Dexcom. In the past, you have been bullish on this stock. However, with the Fed increasing interest rates and reducing its balance sheet to curb inflation, and the changes in the geopolitical environment, what do you think is the future of Dexcom, which is at present trading at such a high multiple?
Right, it is, but remember, they're remarkable scientists there. They do tremendous things. Here's the problem. Stock was at 400 a couple of weeks ago. Now it's at 500. But I think their technology is a winner, and they're going to keep shrinking the size of that device, and that's going to make people like it even more. Let's go to Kyle in New York. Kyle.
Hey, Jim. How you doing? Thank you so much for taking my call.
Oh, my pleasure. What's going on?
Well, Jim, I wanted to ask you about Datadog. I'm a newer investor, but I got into it and had a nice peak over the last, 2 years or so with some of the other cloud companies, but it's dropped off a little bit. I'm wondering, have they hit their peak, or what you think about?
Well, first, it is a great company. I mean, a terrific, terrific company. However, it is losing money. And we are non-operating, but it is losing money. Now, we do not want to recommend any stocks on this show right now when the companies are losing money. It's just too painful and hard. All right. Sometimes pessimism can get out of sync with reality. But for now, I say let that pessimism build. I think the market will price it in more quickly than you think, and then we could be paused for a great rally. Those people who belong to the investing club know we've been selling and selling and selling the last tranche, not just because of our distribution. Mad Money tonight. Palo Alto Networks, one of the few areas, by the way, that is still strong is cybersecurity. They're on the front line of defending the enterprise from cyber attacks, and I'm learning more about the state of the space with the company's CEO because of what's happening with Russia and Ukraine. Then the dollar store operators typically are what you should buy here. They look inexpensive, but are you getting the stocks of major players, Dollar General and Dollar Tree, at a discount, or is it still at a premium? I'm gonna give you my take. And you've called in and stumped me on some stocks. I'm turning in my homework on a couple that I've been watching, and I gotta tell you, one of them is downright exciting. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Look, it's been tough out there, but not every growth stock has been eviscerated over the last 4 months. At least one subgroup has held up incredibly well, and that's cybersecurity. In a world where new digital threats emerge constantly, from ransomware and supply chain attacks to nation-state hackers, including the one that's invading Ukraine, both businesses and governments around the world know they need to spend more money to protect themselves. But not all cybersecurity stocks are created equal. The newer ones with little in the way of earnings have been crushed like everything else with the same profile. But some of the more mature operators with great management are doing terrifically. Take Palo Alto Networks, which just hit a new all-time high today before pulling back a bit. Not only does Palo Alto have everything an organization needs to protect its networks, its cloud, on-premise, you name it, they also turn a profit in the process, and a handy, big, nice profit. There's a reason the stock has surged 31% since we last spoke to the CEO, right after the company last reported 5 weeks ago. Since then, we've seen the rise of a new hacking group that's been hitting some of America's most sophisticated tech companies, not to mention further escalation from Russia. So let's check in with Nikesh Arora, the chairman and CEO of Palo Alto Networks, get a better sense of the cybersecurity landscape. Mr. Arora, welcome back to Mad Money.
Thank you, Jim.
Okay, Nikesh, I've been reading this Unit 42 threat intelligence, and it's just incredible. It's both eye-opening but also, frankly, scary. Can anyone protect themselves, or is everyone vulnerable?
Look, Jim, unfortunately, every one of us is vulnerable, given what we're going through and where we are. But a lot of us can do stuff, and we have been doing stuff, I think, over the last many years, trying to prepare for such times. At this point in time, we all need to be very vigilant. We need to make sure that we control our networks down. We need to make sure that we're constantly monitoring any attempts at infiltration of our networks. And we also have to have a contingency plan in place. We have to make sure that if we get impacted, we can restrict the impact to a small segment of our business and make sure we have backup plans to come back up again. That's what we do in moments of crisis.
True, but then I look at the list, okay? Facebook, they're brilliant people. AWS, we love them. Fastly, that's an outfit just dedicated to secure sites. Akamai, they were always considered to be the gold standard. We got a Verizon issue. And then, finally, Okta. I mean, Okta, Nikesh, come on, Okta is the people. That's who we rely on to have our entity protected.
Jim, what's interesting is the cyber attackers have gone from being hobbyists to professionals. And when you're a professional, you look and you go for maximum impact. And how do you get maximum impact? You get maximum impact by embedding yourself into something we all use. That's why you've seen over the last 2 years, the hacks have been towards supply chain software, Okta, something we all use for identity, Microsoft Exchange Server, SolarWinds, something we all use for IT configuration, Log4j, something we all use in our development process. So you are seeing more and more supply chain attacks. And what that does is allows them to get embedded in specific targets. So when they tomorrow want to come looking for a company, a piece of critical infrastructure, they can then go look through all these hacks and see which ones of them still have that vulnerability persisting, or which ones infrastructure they've been able to go and sleep in. So I think from that perspective, they're doing it the right way, unfortunately. And our job is to make sure we're vigilant. We're making sure that none of this stuff gets through into our system. And if it does, we have remediation plans, and we have remediation plans that apply to all of our customers quickly. Because the problem is anybody who doesn't patch, anybody who doesn't upgrade has left themselves open to this vulnerability.
But for some, remediation might be too late. I mean, Nikesh, I have to think that at a certain point, the bad guys who have stepped everything up since Ukraine aren't going to go for money and aren't going to go for chaos. They're going to go for blood. How can they hurt us? And I'm not kidding. We had someone on talking about heart valves yesterday. And what do we talk about? Can they hack that? Can they hack a machine that works to be able to monitor your insulin? Can they hack the insides of a nuclear power plant?
The short answer is yes. And Jim, you and I talked about this maybe 5 weeks ago, and I said, this is the time I'm most concerned about the cyber activity, because this time it is not for economic gain. It could be for vindictive reasons. And it's very hard to get somebody to stop if they are intent on causing chaos or causing damage. And that's why we have to be extra vigilant. And by the way, this has been backed up by the White House, been backed up by CISA. They've all said we need to be on full alert, especially critical infrastructure, especially financial services, areas where any degree of shutdown can cause chaos. And I think, I know there's been a lot of conversation around, we haven't seen anything yet, and I think it's early. I think the potential aggressors are still busy dealing with other issues, and at some point in time, because we have done economic sanctions, we have caused some degree of economic warfare. My fear is that we will see some vindictive behavior in our direction. We need to be ready for it.
All right, now, I understand that how good they are. Will I ever wake up and find that Gamestop from Russia has been hacked by us, and they are on their knees asking for help?
Look, that's not a decision that we as a private enterprise should be taking. We're not in favor of any kind of cyber attacking, but I would leave that for the elected officials to decide what's the right strategy given which circumstance we're in. Of course, we have offensive capability as a nation, and that capability exists in other nations around the world as well. But I hope it doesn't come to that. I think our job is to make sure we protect our infrastructure, because our responsibility is towards our citizens and our enterprises in this country and other countries around the world, which are on the right side. And that's what we're going to focus on.
Okay, so Nikesh, how does this happen? One of my colleagues got a message. Your bill is paid from Verizon. Your bill is paid for March. Thanks. Here's a little gift for you. How did they get his phone number? And two, how can you resist that?
Well, these phishing attacks, these attempts to somehow compromise your credentials are the hardest things to protect against, because there's one attempt to go do the supply chain attacks where they get embedded across infrastructure. The other is you go after specific individuals who work at companies or specific individuals that you're interested in and try and get them to surrender their credentials, which is how we read the Okta hack happen, or some of the others have happened. This Lapsus group does work like that, where they go find compromised credentials on the dark web, use them to log in legitimately on your behalf, and then they're able to enter your systems and do things that you don't want them to do. So for that kind of stuff, that's the hardest thing to protect against, because you're as secure as your 12,000th employee in our case, or your 350,000th employee in some other case. In that case, you've got to be constantly monitoring your systems, looking for anomalous behavior, looking for behavior that is out of the ordinary, and despite somebody being trusted, being able to shut them down. So this is going to happen, Jim, and we just have to make sure that we get our technology to a place where we're actually relying on machine learning, continuous monitoring, AI, to make sure we're stopping attacks as they happen, not after the fact, analyzing them and trying to figure out how to get back up.
But if you're one of these companies that got hurt like this, I mean, look, every one of my bank cards has been hacked. All of my phone lines have been hacked. Can I expect one of those companies, don't we have some ability, or is it just totally against the law for one of these companies to be able to say, you know what, we're going after these bad guys?
Well, I think, Jim, part of the challenge is that it's not clear who these bad guys are, right? There's so many obfuscation techniques. There are so many different ways. In some cases, there are individuals who are in some remote part of the world, and it's very hard to identify. Our entire legal process and legal system is set up in the physical world. We don't have a digital system, digital world-based sort of legal process or process to investigate. So from that perspective, I think it's very hard to find out actually who did this to you. In the first place.
Well, look, I'm glad you're out there. I want everyone, by the way, they all should be reading your blogs, which are the best way to find things out. And you don't mince words. One of the things that's so great, I mean, Lapsus, or what happened with Okta, I found out about all this stuff because of you and because of your blogs. And I think that's probably the most informed way to keep up with what's happening, which is pretty much, unfortunately, every single day. That's Nikesh Arora, Chairman, CEO of Palo Alto Networks. Thank you, Nikesh. You're keeping us right on target, all right?
Thank you, Jim.
You in Unit 42, which I would never be smart enough to go to, but I can read their stuff. Thank you so much. Yeah, buddy's back here for the break.
Coming up, when the value of a dollar takes a punch, what happens to the value of a dollar store? Kramer checks in on the discount names that could be ready to prosper with inflation. Next.
do when consumers are getting squeezed like they are now? Between the rampant inflation in everyday goods and the end of government stimulus programs months ago, well, shoppers have to do more with less. As we talked about at the top of the show, it could be a tough time. In a normal market, this would be the perfect time to buy the dollar stores as people start trading down in order to save money. But we know this isn't a normal market. We've got the worst inflation in decades, so the cost of making even cheap products has risen rapidly. Meanwhile, there's supply bottlenecks all over the place, causing freight costs to skyrocket. And of course, labor's more expensive too. Wow. So if you're running a dollar store, that means you're in a tough spot. Given the nature of the industry, you can't really raise prices like so many other retailers are doing, at least not significantly, because it invalidates the whole premise of the dollar store. That means these dollar store chains have to eat their higher costs rather than passing them on to you. It's a good news, bad news situation. They benefit from the trade down dynamic, but they take a beating on the margin front. You know how much the growth stock buyers that concentrate, guys who concentrate on stocks, they always want to see higher gross margins, not lower. And that's why I haven't spent much time focusing on the dollar stores for you lately. That not all these companies are created equal. There are two major players here. There's Dollar General. You've probably been to one of those. And Dollar Tree. I got one right near me. Both reported earlier this month. And while the results were far from perfect, both stocks have roared they've roared really rather amazingly since they reported. And they bottomed in late February. That's why I want to take a close look, because there could be something interesting going on here. First, though, let me give you the backdrop. For years, from 2015 through 2020, Dollar General trounced the stock of Dollar Tree. Look at this. This is a major difference in performance. Really big. Now, the former's up 193, and the latter's only up 40%. And that's over the exact same period, as you can see. We're taking a look. What we're looking at here, you see 2015 to 2020. Now, that's before you even calculate the value of Dollar General's dividend versus Dollar Tree's lack of dividend. Now, why was there such a large disparity? Because in 2015, Dollar Tree bought the worst run of the publicly traded dollar store chains, Family Dollar. It turns out to be much worse than they thought. They actually won a bidding war with Dollar General over this asset, paid way too much, that made it into a Pyrrhic victory. For the next 5 years, the Dollar General stock thrived while Dollar Tree languished, weighed down by the shabby Family Dollar concept. After years of struggling, Dollar Tree finally started turning things around in 2019. Then the pandemic hit, and both stocks got pulverized. You can see it, some outperformance, and then some, well, anyway, boom. In the end, though, COVID turned out to be the great leveler for these two companies, because initially, they both printed money. They were essentially declared essential stores. See, right here, they went up because the government said, you know what, we need Costco, we need a couple of big, we need Home Depot, we need Lowe's, and we need the dollar stores. And that allowed them to stay open when everyone else was in lockdown. Then the lockdowns ended, and people started getting government assistance checks that allowed them to trade up to higher-end retailers. That was not great for Dollar Tree or Dollar General. And that's where they're coming from. Now, thanks in part to a long period of elevated inflation, it's worth noting that neither of these dollar stores are actual dollar stores anymore. At least not if you mean stores where nearly everything costs $1 or less. Dollar Tree and Dollar General have been raising prices for a while now, but this is an interesting saga. In fact, Dollar General made this move long before the pandemic. Until just recently, only about 20% of the merchandise was $1 less. Remember when President Trump slapped tariffs on all sorts of cheap Chinese exports? Well, that's when Dollar Gen jumped at the chance to pass those costs on to its customers. By contrast, Dollar Tree held the line for much longer, at least at its core Dollar Tree locations. They experimented with other price points at Family Dollar. But last fall, as inflation continued to bite into their margins, the company finally gave in and started testing out higher prices even at their goods stores. That news last September, accompanied by a monster buyback announcement, caused the stock to catch fire. Now I want you to fast forward to late November. Dollar Tree went all in, okay, increasing the price for essentially all items to $1.25. The buck was already broken, and they figured they got tired of pretending otherwise. Here's the interesting part. As soon as Dollar Tree put through those across the board price increases, Dollar General goes in the exact opposite direction. They started making more products available for just $1 and added more displays for their $1 inventory. While Dollar General is pitching this as a move to help their customers, who often struggle to make ends meet, especially if they're on a fixed income, it has the added advantage of luring away disaffected Dollar Tree customers who don't like paying an extra quarter. Now, there's another angle to the story that might be the most important one. In mid-November, we learned that an activist hedge fund called Mantle Ridge had built a 5.65% stake in Dollar Tree. They wanted to change the pricing strategy, which they got, and some major improvements at the Family Dollar business. Thank God, because, whoa, those stores still aren't nearly as good as the Dollar Tree stores. But they clearly didn't get enough, because a month later, Mantle Ridge nominated a full slate of 11 directors to replace Dollar Tree's existing board. As soon as I saw the news, I said the stock was a buy, because activist pressure can work wonders, especially if it's a smart activist. And Paul Hilal from Mantle Ridge is very smart. Earlier this month, these moves paid off as there was a major shakeup in Dollar Tree's board of directors, Mantle Ridge getting 2 seats, and the chairman was forced to resign. I think this is a huge reason why the stock has run from 113 in early November to 160 today. So this is activist pressure that made a lot of this happen, okay? With that in mind, let's talk earnings. When Dollar Tree reported 4 weeks ago, their same-store sales and net revenue came in a bit weaker than expected. However, their margins, remember what I told you, that's what people want, held up much better than feared, resulting in a terrific 23% earnings beat off a $1.78 basis. According to management, shoppers aren't batting an eyelash at the new $1.25 price point, and their guidance was solid, too. Stock barely budged on the news. It only caught fire a few days later when we learned that the activists at Mantle Ridge were effectively taking the reins. Dollar General reported a couple of weeks later, and their results were a lot less encouraging. Weaker than expected sales, weaker than expected gross margins, and only a tiny 1-cent earnings beat. While Dollar General's guidance for the current quarter was outright bad, their full-year forecast was much more bullish, that's very unusual, which allowed the stock to actually rally in response. Doesn't hurt that they got an aggressive expansion plan that Wall Street greeted with enthusiasm. And, of course, this is what you buy, needless to say, as I said at the top of the show, when people think we're going into recession. They trade down. Stock jumped from 212 to 230 over the next couple of days. Let's pull back to the low 220s since then. How about valuation? Dollar General, slightly cheaper, 19 times this year's earnings estimates versus over 20 times for Dollar Tree. They both have similar size buybacks. Dollar General is still the only one that pays a dividend, and they just raised the payout by 31%. But even that, it still only translates to about 1% yield. Where do I come down? Here's the bottom line. If you want a consistent operator that doesn't need to do anything too crazy to beat the estimates, well, that's Dollar General. Even though they're lowering prices, I think that's a good long-term strategy to win over customers. Dollar Tree is more of a high-risk, high-reward turnaround play, where the stock could have a lot more upside if they pull off the execution. But if they screw it up, you can kiss your gains goodbye. Oh, and a shopping tip, I love my Dollar Tree a lot more than I like my Dollar General. Let's go to Stallion in Wisconsin. Stallion.
Hey, Jim, how are you?
I am good. How are you?
Hey, good. Hey, question. Shopify was on a huge run during COVID. However, the stock dramatically decreased during earnings. Do you think the company is overvalued, or do you think it's a buy?
Wow, what a great question, because you know I like Shopify, and I've liked it from much lower levels. What I have to say is it's now a show-me stock. The last quarter was not what people wanted. So we literally have to wait for this quarter to see that it was just something, a new trend, or whether it was just one-off. I'm sorry, but you may think that that's a punt, but I have no choice. I got to see the quarter. Fred in California. Fred.
Oh, yeah, Jim.
Whoa. What's up?
So, thanks for taking my call.
Of course.
And you gave me an A-OK on my investment in Qualcomm. The other stock I like, it's a place I buy gas, cheapest price in town. I stop for lunch there and get a slice of pizza, and I go in the store. I can buy my beer, wine, steaks, and even buy lobster. I can also buy my clothes, pots and pans, appliances, pharmacy products, even tires when needed. When people check out, their shopping carts are filled to the brim. Wow, what a place. I think I should buy stock in Costco. What do you think, Jim?
I actually do every one of those things except for not the lobsters. I get the crab legs. The ones much better than where you can get them anywhere else. The answer is yes, you should buy. Buy slowly because it does come down. Huge position for Mike Charitable Trust. And we talk about it all the time. It's one of the few positions we did not want to touch when we had the distribution that we gave, of which we're dribbling money out very proudly to $100,000 today to First Aid, just for people who are disadvantaged, let's say, by what the Russians are doing in Ukraine, which I feel is a travesty. Anyway, it's a tough run. When you're trying to run a dollar store, when everything goes up in price, to keep it at $1. However, Dollar Tree and Dollar General are two players worth watching because they've been dealing with this very well. Dollar General is the consistent operator with a great strategy to win over customers. Dollar Tree, much more of a high-risk, high-reward turnaround play. Remember, go to them before you buy. Make sure you get comfortable with the concept. Much more made money at. You stump me on Alto Ingredients and Gladstone Land. I'm going to turn in my homework on the two stocks to see if either provides an enticing buying opportunity. And what can the United States do to aid Ukraine in their fight against Russia? You know how aggrieved I am about this. I'm discussing some potential actions. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer. Whenever I get a call about a stock that I'm not too familiar with, I like to take a beat, do some research, and then circle back with a considered answer. Whether here or with the CNBC Investing Club, my mission is to help you become a better investor, which means I need to be responsive to your actual questions, not just what I think you should know. For example, I get a ton of questions about ultra-hot stocks all the time, some of which are relatively unknown or under the radar. And those always deserve extra consideration because I don't want you to get burned by something that's already overheated. That's why tonight I want to catch up on our homework with a pair of stocks that have just been on fire lately. Let's get to it. On March 1st, Near in Pennsylvania asked about a teensy-tiny company called Alto Ingredients that's barely big enough for us to talk about. And that's because there's certain size considerations for what we say on air. And I said I had to do some digging to get familiar with it. Now, right off the bat, I need to apologize for taking too long to circle back to this one. When you asked me about Alto, it was just trading at $5 and change. Since then, it's rallied 17% to just under $7. In retrospect, it was obviously a fabulous opportunity. So what's the story here? Okay, Alto Ingredients makes specialty alcohols and other essential ingredients that are derived from crops. We're talking ethyl alcohols, renewable fuels like ethanol, along with foodstuffs like yeast, corn, gluten, high-protein feeds for livestock, grain-neutral spirits, even carbon dioxide for the beverage industry. They've got exposure to a broad array of end markets: home health and beauty, food and beverage, essential ingredients, renewable fuels. And within those end markets, Alto's got a pretty impressive list of customers, including everyone from Procter & Gamble to Nestle to Church & Dwight to Chevron. However, the company's also got a history. That's not so good. Alto Ingredients originally came public in 2005 under the name, some of you probably know this, you're just going to laugh when you hear it, Pacific Ethanol, right? And for most of its existence, the stock had been a total dog. Initially, the business was all about making ethanol for cleaner, greener fuels. Back in the day, there was an ethanol boom that imploded a little over a year after Alto came public. Then it got hit with another huge leg down when the price of oil peaked in 2014, which made ethanol totally uneconomic versus fossil fuels. These guys lost money pretty much every year from 2015 through 2020, with the stock plummeting to just 22 cents when the COVID crash hit 2 years ago. From peak to trough, Alto lost 99% of its value, which is a situation that companies rarely come back from. But in the last 2 years, Alto Ingredients has rallied exactly 3,000% off its March 2020 lows. How they do that? One word: diversification. Before the pandemic, these guys had a small sideline in specialty alcohols that go into hand sanitizers. And that business, of course, caught fire thanks to the pandemic, essentially saving the company from ruin. By the fall of 2020, management realized they were on to something. So they announced a complete strategic realignment, shifting from its focus from ethanol to specialty alcohols and essential ingredients. That's when they changed the name from Pacific Ethanol to Alto Ingredients. Unfortunately, management overestimated the scale of the opportunity. They started missing sales expectations in the fourth quarter of 2020 because the forecasts were too high, and they struggled with execution for much of last year. That said, Alto's also made some important moves. They sold off some ethanol capacity. They used some of those proceeds to pay down all of their long-term debt. They even made a small acquisition a couple of months ago, picking up a profitable specialty alcohol business. Now, though, in an ironic twist of fate, Alto's stock has caught fire, and this time it's all about ethanol, which is suddenly a lot more competitive with the price of oil back in the triple digits. And that's how the company could shoot the lights out when reported just 3 weeks ago. Where do I come down on this one? While I'm wary of anything that's up more than 40% for the year, Alto's what I call an orphan stock. It's a $500 million enterprise with light analyst coverage. Only 3 analysts follow the stock. They all seem to like it. This could be terrific material for speculation in the right environment. Now, it doesn't hurt that Alto's only trading at 13 times earnings, assuming they can make the numbers this year. In the end, it's pure speculation. If you believe oil prices can stay elevated, then I think Alto Ingredients could be worth betting on. But I recommend buying it in gradual small increments and only with money you can afford to lose. What can I say? Near's got horse sense. Next up, last Wednesday, we got a call from Terry in Washington about Gladstone Land Corporation. I said I'd circle back. Gladstone is a real estate investment trust, or a REIT, that specializes in farmland that it leases to farmers on what's known as a triple net basis, meaning the farmer is on the hook for rent, insurance, maintenance, and taxes. Now, this thing used to have a fabulous dividend yield, but even though management has consistently raised the payout, well, guess what? They haven't been able to keep pace with the massive run in the stock over the last couple of years. So, in other words, distribution's good, but the stock's going up, so the yield's going down. The run in Gladstone is actually pretty straightforward. We've had extreme food inflation, and you better believe that makes farmland much more valuable. Even before Russia invaded Ukraine, potentially taking 13% of the world's total calories off the market, thank you, AGCO, for that figure, demand for farmland was growing. Between a steadily rising global population and a steadily shrinking supply of arable land, a farm turns out to be a real good investment. I know, I bought one myself. That said, Gladstone's most recent leg higher is all about Ukraine. Ever since the breadbasket of Europe became a war zone, this stock has rallied roughly 27%. So the question is, can you continue that rally? Let's start with the positive. Gladstone's a very well-run company. Their acreage is 100% leased, and they've got a strong system in place for bringing new property that's perfect for farming. Long-term, I believe it's an excellent business, and I'd be a buyer at the right price. But I don't think the right price is this price. Right now, Gladstone sells for 46 times this year's funds from operations, FFO. That's the real estate investment trust equivalent of earnings. That's incredibly high. By comparison, our favorite data center REIT, Equinix, sells for 25 times funds from operations. And that's a great one. I can't countenance buying Gladstone up here. Sometimes you just have to admit that you missed it. The bottom line, stock picking is like baseball. There are times to swing away and times when you have to keep your bat on your shoulder and wait for a better pitch. You have my blessing to swing at Alto Ingredients. But Gladstone land is coming in way too high. Mad Money's back after the break.
No need for a meteorologist. Today's forecast calls for thunder and lightning. The lightning round is next.
It is time. It's time for the light round. And then the lightning round's over. Are you ready? Ski day. Time for the light round. Let's start with Brad in Kentucky. Brad.
Booyah.
Booyah. Booyah.
I was wanting your take on EVgo or any electric vehicle
Okay,
stock
electric vehicle. The only electric vehicle stock that I'm recommending right now is Tesla. This one's losing a fortune. No, thank you. Let's go to Rick in Pennsylvania. Rick.
Booyah, Jim.
Booyah.
How are you?
I am good. How about you?
Good, good. First time caller, long time listener.
Thank you for calling.
I have GEVO.
I'd like your opinion, please.
Okay. Yeah, so that's alternative fuels. It should be working better here, but it's losing too much money. And ever since November, the money losers are stocks that just go down. Let's go to Michael in Rhode Island. Michael.
Booyah, Kramer.
Booyah.
After this company spins off Warner Media, they should be value-friendly and offer a great dividend. What are your thoughts on opening a long-term position in AT&T?
Maybe long-term. Right now, I think they're doing terribly. It's just not a great company. There we go. Let's go to Tyler in Georgia, please. Tyler.
Hey, Jim. Booyah.
Booyah.
First-time caller, long-time listener.
Great. What's on?
Hey,
What's
thanks
up?
for what you do for us out here. Cosmos Energy, KOS. What do you think?
Good
Should I
company.
hold
Good company. Makes a lot of money. Kind of interesting to me. Want to pull back? You got to buy it. Just the right place to be. Let's go to JJ in New York. JJ.
Hey, Professor, I have a question for you. What
Sure.
do you think of RADA, R-A-D-A Electronics?
Man, that stock is just... Look, everybody wants defense contractors. This is an Israeli defense contractor. It is a very good company. However, it has just doubled. So I can't recommend a stock that just doubled. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by TD Ameritrade. Coming up, Kramer explains why Russian oil may be the factor to demoralize Ukraine and why that would be a black mark on Western ideals. Next.
Let's go to Tim in Kentucky, Susan in Indiana, Anne Marie in Florida, Chris in New York. How about we go to Paul in California, Bob in Indiana, Alex in California, Clay in Montana, Phil in Illinois, Mark in Virginia, Darren in Minnesota.
From every corner of Kramerica, we want to hear from you. Drop us a line on Mad Money.
When the book is written on the Russo-Ukrainian War, I hope it won't say that the Ukrainians lost because the West sold them out. But sadly, that's looking like an increasingly real possibility. The main issue? Too many of our European allies are hostage to Russian natural gas supplies. Putin's been pushing for them to pay for that gas in rubles. See, he's killing two birds with one stone. He's raising money and propping up his currency in the process. Now, so far, Western Europe has refused, but they haven't had to contend with energy shortages yet. If they blink, it would be a huge problem. Russia's highly dependent on imports.